Okay, welcome back. Let's talk about statement of cash flows. Now, before we get started, the statement of cash flows, I want you to understand, is the fourth of the financial statements. We talked about the income statement. Income statement, as you recall, shows all of your revenue and your expenses for the accounting period. Yep. Second is called the balance sheet. The balance sheet shows all of the company's assets, liabilities, and equity. The third financial statement is called the statement of retained earnings. Statement of retained earnings sometimes is called the statement of stockholders' equity, but usually called the statement of retained earnings. Statement of retained earnings shows net income minus any dividends, minus any owner's withdrawals, etc., plus any paid in capital equals ending retained earnings. That shows up on your balance sheet as its own line item, but it's also its own report. And the fourth financial statement is called the statement of cash flows. The statement of cash flows shows all of the cash, the physical cash, okay? Cash coming from your customers when they pay, cash going out of the business when you pay your bills. So cash coming in from your customers at the time of the sale or whenever you collected the cash. Then cash going out of the business that you use to pay the company's bills. Cash coming in from the customers and out of the business for bills, we call that part operating cash. Operating cash. The statement of cash flows is broken up into three different categories. And they're broken up by activities. The activities are how the cash is used. Okay? Operating activities, that's the day-to-day operations of the business. Cash comes in from our customers based off of the sales, right? And cash goes out of the business in the form of expenses. We're paying our bills. Those are operating activities, day-to-day operations of the business. Second category on the statement of cash flows is called investing activities. Investing activities. Investing activities is the purchase or sale of property, plant, and equipment. Purchase or sale of property, plant, and equipment. Those are investing activities. I'm investing in the business, okay? By purchasing or selling property, plant, and equipment. Investing in the business. And the third category on the statement of cash flows is called financing activities. Financing activities. In financing activities, I'm financing the business. Taking out a loan, repaying a loan, issuing stock, issuing bonds, etc. Right? Financing. So those are the three categories: operating activities, investing activities, and financing activities. And all of these activities represents the use of cash and the flow of cash coming into and out of the business. So the statement of cash flows shows the physical flow of cash into and out of the business within these three categories: operating, operating, investing, or financing. I'm going to show you what these looks like, and also show you how to calculate the statement of cash flows. So cash comes into and out of the business. What are these cash? The cash coming into the business, it's from our customers for operating activities. It's from the sale of property, plant, and equipment for for investing activities. And we also get cash coming into the business from loans that we took out, the issuance of bonds and stocks for financing activities. That's cash coming in. Cash going out, I'm paying my bills from the day-to-day operations. That's operating. Cash going out, I'm purchasing property, plant, or equipment. That's investing activities. Or I'm repaying a bond. I'm buying back stock. I'm repaying a loan. These are financing activities. So cash coming in, cash going out. And that's what the statement of cash flow shows us, right? Why is it happening? Where is it coming from? Shows us, explains the differences in cash. Cash flow is so important. That's why it's one of the 4 financial statements. The reason why cash flow is important is because it helps the company to decide how to repay its debts. Okay? Company took out debt, has to repay it. If I don't have enough cash on hand, I can't repay the debt. And the way I figure that out is through looking at the statement of cash flows. Cash flow helps us to evaluate the company's ability to pursue unexpected opportunities. In other words, if the company has a good cash flow, I can use that additional cash to expand the business. It's pursuing an unexpected opportunity. The cash flow also helps us to plan day-to-day operations. I need to know how much cash I have on hand in order to pay my bills. It also helps me to know when I'm receiving cash from my customers and when my bills are due to make sure I have enough cash flow coming into and out of the business for the day-to-day operations. And it also helps me as a manager to determine long-term investment decisions. If I have a good cash flow, I might be able to invest in the company by purchasing additional property, plant, and equipment to, in the future, expand the business. So these are the kinds of decisions we would make. These are the kind of decisions we would make from cash flows. Now, another term you're probably already aware of called cash equivalents. Cash equivalents is a term we use to describe short-term, highly liquid investments, such as stocks and bonds. Stocks and bonds can be quickly converted into cash. Therefore, we call them cash equivalents. Cash equivalents. The reason why I might need to quickly convert stocks and bonds into cash is to support the company's operations. So, as I had mentioned, the statement of cash flows is separated into the 3 activities: operating activities, which is day-to-day operations of the business; investing activities, which is the purchase or sale of property, plant, and equipment; and financing activities, which is the issuance or the repayment of a bond, issuance of stock, maybe a loan, those financing activities. But the cash is separated into those 3 types of activities on the statement of cash flows. Operating activities, day-to-day operations of the business; cash coming in from customers, from sales; cash going out of the business to pay bills. Investing activities, cash coming in from the sale of property, plant, and equipment, cash going out for the purchase of property, plant, and equipment. And financing activities, cash coming in from a loan that we took out, a bond that we issued, sold some shares of stock, etc. And then the outflow would be paying a dividend, repaying a loan, repaying a bond, etc. This visual breaks down the operating activities, cash coming from our customers from sales or dividend revenue or collections of accounts receivable. They were receiving interest for something. All of those are cash inflows. Cash outflows are paying our salaries and wages, paying operating expenses, paying our taxes, paying any interest, paying our accounts payables, right? Cash coming in minus cash going out equals net cash flow. Cash coming in minus cash going out equals net cash flow. Cash in minus cash out equals net cash flow. One term there. For investing activities, cash coming in is from the sale of property, plant, and equipment. Maybe we sold a short-term or long-term investment, etc. Cash going out, purchasing property, plant, and equipment, or some other asset. Cash coming in minus cash going out equals net cash flow. Financing activities, cash coming in, I issued some stocks, some bonds. Maybe the owner's contributing money. Maybe we took out a loan. Cash going out for financing activities, we're repurchasing stock, so treasury stock. Paying out a dividend, owner took out some cash for withdrawal. We repaid some loans or bonds. Cash coming in minus cash going out equals net cash flow. And then sometimes there's non-cash investing and financing. Non-cash. Sometimes there might be a deal where you exchange. I think we talked about this last week. You exchanged the purchase of land in the form of stock. So the company received the land, and instead of paying the person for that land, you paid them using stock. That's an exchange, yeah? There's no cash involved. You gave them shares of stock, they gave you land. Yeah, that's an exchange. Other examples might be a lease of an asset, purchase of an asset using a note or a bond, converting preferred stock to common stock. These are all non-cash investing and financing things. So let me show you what a statement of cash flows looks like. Cash coming in minus cash going out equals net cash flow. For operating activities, cash coming in from our customers minus cash going out for operating activities equals net cash flow for operating activities. For investing activities, cash coming in from the sale of property, plant, and equipment minus cash going out for the purchase of property, plant, and equipment equals net cash flow for investing activities. For financing activities, cash coming in from the issuance of bonds, stock, etc., minus cash going out, paying out dividends, repaying loans, etc., equals net cash flow for financing activities. we add up net cash flow for operating, investing, and financing activities to get our net increase or decrease in cash, plus our cash at the our beginning balance equals cash at the ending balance. This is the typical format of a statement of cash flows. The way we prepare a statement of cash flows is the first thing we do is we calculate our net increase or decrease in cash. Then we look at our net cash flows from operating activities, then our net cash flows from investing activities, our net cash flows from financing activities, and then we find our ending balance. Cash is typically the first place we look on our balance sheet to look at our operating, investing, and financing activities that have occurred over a period of time. You can also look at the statement of cash flows based on non-cash accounts. We can look at the statement of cash flows by looking at non-cash accounts. The way we do that is we take our liabilities on the balance sheet, total liabilities, plus total equity on the balance sheet, minus non-cash assets. Non-cash assets are your long-term assets or non-current assets called property, plant, and equipment, etc. And of course, any accounts, inventory, accounts receivable, etc. That'll give you your cash balance. Prepare the statement of cash flows. We also need to look at balance sheets, income statement, and any other additional information that might help us to prepare the statement of cash flows. There are two methods. There are two methods that we use in accounting to formulate the statement of cash flows. One is called the direct method, and the other is called the indirect method. And we do this for operating activities only. This is how we find the net cash for operating activities. There are two methods. One's called the direct method, and the other one is called the indirect method. I'm going to show you how both of them work. The direct method is very straightforward. We follow the transactions that have occurred directly. That's why we call it the direct method. We take cash received from our customers minus cash paid for inventory minus operating expenses minus cash paid for interest minus cash paid for taxes to equal the net cash provided by operating activities. That's why we call it the direct method. It's your cash that came in from your customers minus all the cash you paid out operating activities to equal net cash provided by operating activities. Very straightforward. That's called the direct method. We directly followed the cash. That's why I call it direct method. The indirect method is a little bit more complex. The way we find the indirect method is by taking all the non-cash accounts. All the non-cash accounts. And the way we do that is we take net income minus accounts receivable minus inventory minus prepaid expenses minus accounts payable minus interest payable plus income taxes payable plus depreciation expense plus loss and sale of client assets minus gain on retirement of notes equals net cash provided by operating activities. It's a lot. But here's the difference. Again, the direct method, we follow the cash. Cash received from our customers minus cash that we paid for operating activities. That's the direct method. The indirect method, we take all of our non-cash accounts, start with net income, then subtract or add your other non-cash accounts. They're all current. We just see they're all current, yes? They're all operating activities. Operating. Remember, operating activities, it's the day-to-day operations of the business. But you'll notice that either the direct method or the indirect method, either one that you use, you should derive the same amount of net cash provided. So I'm going to show you the indirect method again, so you have a pretty good understanding of how it's used. Indirect method, of course, being the more complex of the two, so that's why I'm showing you this information again. This time I'm showing you a little bit more visually. Net income, $38,000. Plus or minus all of our non-cash accounts. Ultimately gets us to the net cash, right? So here's how it looks. Net income plus or minus, depending on what kind of account we're looking at. Depreciation expense, loss of sale of plant assets, gain on retirement notes. Then the changes in current assets and liabilities, change in accounts receivable, change in inventory, prepaid expense, accounts payable, interest payable, income tax payable, equals the net cash provided by operating activities. It's a little complex, yeah. That's why it's the indirect method. I personally prefer the direct method because it follows the cash. It makes perfect sense. But sometimes you don't have that kind of information. So when you don't have that kind of information, the indirect method is the only other way to do it. So, and sometimes there's going to be adjustments that are not always obvious that you need to account for. And these are based off of the income statement. Some of these kinds of adjustments include things like depreciation expense, etc., right? So with that, we look at the expenses and losses with no cash outflows. We add those back into net income. That's why we add back in depreciation expense and loss on a sale of plant asset back into net income. And then we back out all of the other operating activities that are non-cash based. And this shows us the impact, right? So if there is an increase in your cash balance during the year, we subtract out net income. We add in net income for the current liabilities. This shows us the difference, yeah? So you can use this table when we calculate the net income to adjust the operating cash flows. A couple more types of adjustments. And these are based off of the changes throughout the year. Change in accounts receivable, inventory, prepaid expenses, accounts payable, interest payable, income taxes payable, etc. These changes are added or subtracted back to net income and ultimately will derive the net cash flow for operating activities. That's what it looks like together. For investing and financing activities, it's very straightforward. There are 3 steps to calculating the investing and financing activities. We look at changes in investing and financing, look at their T accounts, and report the cash flow effects. Looking at from year to year, we can look at the change, $40,000 increase in plan assets. We probably purchased some assets, obviously, $40,000 worth. So that is a change that would be reported under your investing activities. And we go look at the journal entries that have happened throughout the year to also determine the changes that have happened in investing and financing activities. That shows us. We can reconstruct the T accounts to figure it out, etc. For financing activities, it's very similar. We're looking at changes related to finance accounts. So this would be the issuance of stocks and bonds, repayment of short-term, long-term debts. Those are the types of changes we're looking for. Here we have an example of long-term notes payable. That's increased from year to year, $26,000. How did that happen? We can look to see what happened by looking at the previous journal entries and looking at the T accounts, etc. This shows us an example of stocks, bonds that have been issued. Changes to retained earnings. All of these types of changes, we can use them to calculate the net cash flow for investing and financing activities. Using the summary of T accounts. Now, with the statement of cash flows, there are a couple of ratios that's important to note. One of those is called the cash flow to total assets ratio. And this one can be pretty useful in determining the company's ability to generate enough cash to pay its debt. Investors like this ratio because it also gives them an indication of whether they would receive a dividend. So it's a pretty good ratio to use. And the ratio that is operating cash flows divided by average total assets. So we take our net operating cash flows found on the statement of cash flows divided by average total assets, balance sheet. Average total assets is beginning balance total assets plus ending balance total assets divided by 2. And you can always use a spreadsheet, Excel spreadsheet, to calculate your statement of cash flows. This also helps you to make any type of estimates that you might need to make. But for all intents and purposes, my recommendation is in order for you to generate your statement of cash flows, please use some accounting software like QuickBooks, Sage, Oracle, etc. And this slide kind of shows you graphically the direct method for the statement of cash flows for the operating cycle, and it's just a nice graphic to show you what those changes look like. And this slide you'll find helpful, especially when it comes to answering a couple of questions on homework. It just kind of gives you a nice summary of the direct method. Any comments or questions or concerns about the statement of cash flows? I think it'll. All good. Okay. Awesome. Thank you. Let's switch gears real fast and talk about final exam. The final exam. Oh my goodness, the final. Can you believe we've made it all the way to week 8? Sometimes I can barely believe it. So we're at the end. This is our last lecture together for this course. Let's talk about the final exam. I'm going to switch to student view. Now I want to show you the final exam. A few of you have already taken it. Great. Awesome. Yeah, no problem. You're more than welcome to take it now. I usually recommend to wait until after you've completed 15 and 16 before taking the final. Now the final exam, it's worth 20% of your total grade. That's kind of a lot, yeah? It is a lot. There's 20 questions. It's a mix of true, false, and multiple choice. The final exam covers, let me show you. The final exam covers chapters 9 to 16. 9 to 16. 9, 10, 11, 12, 13, 14, 15, 16. That's 8 chapters. So there's 8 chapters, there's 20 questions. You're looking at probably about 2 to 3 questions per chapter. Okay. Let's take a look where each question falls. So this first question, talking about bonds and bonds sold at par. So this question probably comes from that chapter we talked about. It was all about bonds, remember? That was probably a few weeks ago, I think. It was like 3 weeks ago, so it was probably around chapter 10 or 11. Question 2 has to do with depreciation. Looks like depreciation to me. So the depreciation chapter, I want to say it was from week 5, right? Question 3, partnerships. Partnerships, that was a whole chapter. Was that one last week? I think it was. So that one's from partnerships. A lot of times it's real simple to figure out which chapter the question came from by reading the question. Read it carefully, okay? You see a word like partnership. Well, we know it came from the partnership chapter. And it's just a matter of that type of way of figuring out what chapter it came from. Chapter 4, the allowance method. So that was probably back in week 5. I think we talked about how to estimate like the allowance for doubtful accounts and uncollectibles, etc. Question 5, this is another bond question. So it probably came from the chapter on bonds. Question 6. Other comprehensive income. Other comprehensive income. I think it's going to probably come from that last chapter we just did. Question 7, bonds. Question 8, preferred stock, stockholders. So that one came from, I think, 2 weeks ago. Question 9 is about warranties. That one was early on. I want to say it was probably week 5. Question 10, statement of cash flows. We just talked about that, so that's chapter 16. So you can tell they're mixed, right? The questions are randomized. Okay, these questions are randomized, so they might not even be the same question when you get to the exam. But the point that I'm trying to make here is that read each question very, very carefully. It tells you basically which chapter that question came from. So this will help you to better answer these questions. A way to be successful on this exam is review the PowerPoint presentations. Review the quizzes and homework assignments. Because some of these you might have even seen before. But definitely the PowerPoint presentations, those will come in handy. Look at the summaries in the textbook. Those are really, really helpful. And if you don't know, take your time. Yeah, take your time. The exam's open now. It's due on Sunday night. My recommendation is complete chapters 15 and 16 first. Okay, the quizzes, the homework assignments, whatever, first. And then take the final exam. The final exam must be completed by Sunday night. Okay? Cannot accept it late. The last day, Sunday, that's it. Cannot accept it beyond the Sunday. So I have to report the final grades to the university by Tuesday night. And so Sunday night's last day you can take this. It cannot be late. I cannot accept it late. I can't accept anything past Sunday night. So if you have any remaining items, any late quizzes or exams, any late anything, yeah? Sunday night, that's it. Can't accept it past then. Question 11 here is receivable turnover. That's a formula. All you got to do is plug in those numbers or in that formula, be able to answer that. Question 12, let's see, upcoming, there's a journal entry. This looks like an adjusting journal entry. Question 13, true or false, and it's about cumulative preferred stock, dividends, and arrears. That's from that stock chapter. Stockholders' equity, another stock question. It's a definition, right? Statement of cash flows, we just talked about that, so that's chapter 16. Unrealized gain or loss. Extraordinary repair. Oh, I remember talking about that. Question 18, issuance of price of bond. So that's the bond payment chapter. Question 19, partnership accounting. We talked about last week. Chapter 20, statement of cash flows. Any questions on the final exam? Any questions at all? Final exam. All good. Okay. Take your time with it. You can save and close it. You know, it's open book, open note, open whatever. Save and close it, come back to it, take your time, yeah? But remember, you have to submit it Sunday night. Go ahead, Asia.
I'm sorry. So it is only one attempt, even though we can close it in open.
Only one attempt, yeah. It's only one attempt on exams. The midterm exam and final exam, it's only one shot.
Okay.
Yep, but you save and close it, come back to it, and then whenever you're ready to submit it, you looked at all 20 questions, you feel confident, click submit. Good question. Any other comments, questions, concerns? Okay, so it's a busy week. Yeah, it's the last week. So, Chapter 15 quiz, Chapter 16 quiz, and the final exam. All three of these items are due this Sunday night. Please start now. I really want you to get ahead of this. I don't want you to be scrambling on Sunday night trying to finish all three of these, yeah? So please do it now. 15 quiz, 16 quiz, and the final exam. Any other comments, questions, or concerns? Okay. Thank you all so much. I appreciate all of you. It's been a wonderful 8 weeks. Some of you I'll see again in Principles of Accounting 2, which starts next week. And then some of you, I'll probably see you in the spring for Principles of Accounting 2. But thank you all so much. Appreciate all of you. Hope you enjoyed the course. If you ever need anything, you can email me, call me, set up office hours, whatever you need, I'm here for you. Thank you so much. Best of luck. And stay in touch and all that good stuff. All right, y'all. Have a wonderful rest of your day.
You too, Professor.
Thank you so much. Bye-bye.